This lecture will be focusing on IVICs. IVICs are individual variable insurance contracts. And another name for individual variable insurance contracts you probably see in your book is what they call seg funds, basically, or segregated funds. Now, this particular lesson will only focus on one aspect of segregated funds. That's the difference between a load and a fee. The loads basically are a one-time charge. So the important thing to remember is that a load is charged once, and that's about the size of it. Okay. A fee, on the other hand, is charged all the time. So your management expense ratio, your MER, is a fee because it's charged every single year against the value of the fund. Whereas a load, in actual fact, is just charged once. So the difference between one and the other is one is charged one time only, the other one is an ongoing expense. There are four different kinds actually of loads, you might say, that insurance companies will charge. The first one is what we call a front-end load. This is where the individual is basically saying, okay, I'm going to charge you 5% of whatever deposits that you make. So if you give me $10,000, for example, 5% of the $10,000 is $500. So therefore, the only amount of actually investment is $9,500 because the other $500 actually went into the insurance company to pay their expenses and, of course, to pay the agent and so on and so forth. Okay, so a front-end load basically says we're going to charge you let's say a 5% fee right up front on any deposits that you actually make. The back-end load is exact opposite. It basically says when you take money out at the other end, so for example, 10 years from now, you decide that you want to cash out or something, they will charge you, say, 5% of the total fund value. So it isn't just your money only, it's whatever the value is that 10 years down the line, you're going to get, let's say, 5% of that particular value will be taken off, and then the rest of the money will, of course, be paid to you. So those are two fundamental differences. One is right up front, the other one is actually at the back end. Now, in between that, what you have is what we call the deferred sales charge. In other words, this is not front end or back end. It's really sort of in between. So what you've got is a situation where this individual will, in fact, be paying a load depending on when he actually takes out the money. So, for example, if he took out the money in the first year, he'd probably be charged 5% of whatever money that he took out. But as the years go on, from basically year 1 to year 6, on a decreasing basis. So in the 5th year, for example, you may only take out 1%. On the 6th year, it's over with. In other words, you don't really have to turn around and wait until maturity or anything. They will, in fact, charge you on a yearly basis on what we call a declining scale. Usually what happens here is they start out at 5% and it goes down to 0. And basically 6 years is what you're looking at for 0. Once again, it's one time, they charge it, and that's the end of it. The last one is what we call the no-load fund. This is really where, in fact, there isn't any of these things at all. So what happens? How do the insurance companies and how do they pay their bills and so on? What do they do? But on a no-load fund, basically what you'll find is that the MER, in other words, the fee, in fact, is going to be higher. So therefore, they actually make their money from the MER because they do end up not charging you a load of any kind. So you'll find in this one here, the fee is actually higher than a comparable plan.